Have you ever wondered what makes investors cautious when buying bonds, or why banks demand collateral for certain transactions? The answer lies in understanding credit and counterparty risks, which are fundamental to the functioning of financial markets. In today's session, we'll explore these risks, how they affect financial instruments, and how institutions try to manage them. Let's begin with credit risk. What exactly is it? Credit risk is the risk that a borrower or issuer will fail to meet their payment obligations, either interest or principal. In simple terms, it's the risk of default. This risk is especially relevant in instruments like bonds, debentures, and commercial papers. The greater the perceived risk of default, the more return or yield investors demand. That's why credit risk is priced into the value of market instruments. So, how do we measure this? We rely on credit rating agencies. They assess the issuer's financial strength and assign a rating. A lower rating signals higher credit risk, which leads to a higher yield spread over the risk-free rate. That means investors expect more return to compensate for more risk. If the issuer's rating is downgraded, the price of its instrument drops because the market demands even higher returns. Let's understand this with a concept called credit migration. Suppose a company's credit rating falls from AA to BB. This downgrade means more risk and the bond's price drops to adjust for the higher yield investors now want. So remember, default risk equals failure to make payments. Credit migration equals movement in credit rating. Higher credit risk equals higher yield, lower market price. Now, what about complex instruments like derivatives, such as interest rate swaps, forwards, or currency options? Even though these are not traditional loans or bonds, they still carry credit risk because they depend on the performance of both parties. This is where mark-to-market value comes in. The value of a derivative changes with the market. If that value is negative for one party, that party might be tempted to default, especially in volatile conditions. That's where credit risk emerges, not just from current exposure, but from potential future exposure. What is the link between market risk and credit risk in derivatives? The value of a derivative fluctuates with market factors like interest rates and exchange rates. So, as the market value of a derivative changes, the risk that the counterparty won't fulfill its obligations also changes. If a derivative's value becomes positive for one party, that party is effectively owed money and is exposed to the risk that the counterparty might default. Let's now talk about counterparty risk. Is it different from credit risk? Not exactly. Counterparty risk is a specific type of credit risk. It refers to the chance that the other party in a financial transaction, especially in over-the-counter, OTC, deals like swaps or forwards, will default. This risk isn't static. It changes with market movements. If the market value of the transaction becomes more favorable to you, your exposure increases, and so does your risk if the other party fails to pay. Now comes an important operational risk, settlement risk. What is it? Settlement risk arises when one party in a financial transaction fulfills its obligation, but the other fails to do so. This is especially dangerous in large value transactions or cross-border trades. For example, imagine a bank transfers government securities to a counterparty but doesn't receive payment in return. This disrupts the system. To minimize such risk, systems like RTGS, real-time gross settlement, have been adopted in India. RTGS allows real-time, one-to-one settlement of payments. But what about markets where RTGS isn't applicable, like Forex or government securities? That's where central counterparties like the Clearing Corporation of India, CCIL, come into play. They act as intermediaries, ensuring that even if one party defaults, the transaction is still completed. That's all for today's lecture. If you found this helpful, don't forget to like, share, and subscribe.